Jason, as you provide the commentary there, it's very clear we're picking up still on the back end of some of these pandemic trends. But in future, we know that the industry has been talking about a transition around climate change and how it prices for various customers down the track. How difficult does that make in terms of forecasting into the future in coming years on these premiums?
I think we've taken the best view that we can around transition in the economy through into our products. There are clearly each industry is very, very differently affected. So we have our obligations, to continue to ensure, good quality businesses, but we're also making sure that we engage with them, whether that's from investment or underwriting, to a lower carbon economy. And our product suite is having to adapt, and our choices around underwriting are also adapting very quickly to the new economy.
Jason, good morning. I'm just really intrigued as to how companies like yours, particularly on the life insurance and annuity side, negotiate these spiking inflation rates. I mean, if it is temporary, that's fine. But if this is here to stay, it has a lot of implications for the kind of policies that people are going to want, and indeed for the bond portfolios that you've got for liability matching.
That's right. I think our view is that inflation will spike and will come back down during the course of next year. If your hypothesis is right and it continues, I mean, broadly inflation, so long as it's not caused by a big reduction in economic growth, is a good thing for yields. Clearly, we're a big investor, but we're also match. So actually, higher yields, broadly is a good thing. That will give us more investment opportunities as we look forward. We are still at extremely low rates compared to history. So I think we face into inflation, obviously on the wage side and some of the claims side, with confidence that actually the economic growth that is driving most of this inflation is a good thing for our business.
We've obviously been very focused on protection and health, particularly around the rise in the mortality rate as a result of COVID. As I look at your overall sales, flat, I think, for that business unit, but health up 12%. Can I ask you around the trends you're seeing there? Is the rise in premium that you're probably implementing now having any impact then on that sales line? And what has the higher mortality rate meant for you? So mortality rate is sort of adjusted pretty quickly, back to pre-pandemic levels across the board. We write both annuity products and life insurance products, one of which, so they sort of offset and balance each other out. Broadly, our business has been pretty balanced in terms of our exposure to that. We have seen, slightly higher life insurance rates, but not so materially higher that it's prohibitive. And we've been able to support both in terms of companies buying life insurance, which is a big part of our business for their staff, and also on the individual side. And it's been slightly softer as we've seen through the lockdown. But as we've come out of that, both advisors and mortgage market activity, which is a key driver of the growth there, we anticipate continuing to provide a step up in growth into next year.